morning over some optimism that Russia may contribute a larger production cut. First, Russia was pushing back. Joining us right now is the Schork Report publisher, Stephen Schork. And Stephen, it's good to see you this morning. Your thoughts on what OPEC may do in the face of this big sell-off in oil over the last 2 months, down 20%.
Right, Maria, and what we're seeing actually is a reignition of the rift between the Sunni side of OPEC and the Shia side of OPEC. Let's keep in mind that the only thing, well, I mean, let's be honest here, a Sunni Arab, the only thing they hate more than a Shia Persian is a Shia Persian with a nuclear-tipped ICBM. So this is Groundhog Day in the oil markets. This is November 2014. If we remember back then, oil prices, like today, had come off 30% from their summer highs. We were going into the OPEC meeting, and Iran, like today, was suffering from sanctions given its intransience with regard to pursuing a nuclear weapon. So like 2014, the Saudis did nothing at the November OPEC meeting, and they allowed the market to tank. I think we're at that situation right now. I think the rhetoric coming out of Saudi Arabia, the nonchalance of, well, let's have a 1 million barrel cut when the market expectation was for a 1.5 or even 2 million barrel cut. They are actually daring the market to go lower right now. I'm not optimistic we'll get any sort of meaningful deal out of OPEC today.
Stephen, that 2014 episode hurt in some ways the U.S. economy because when prices fell, it really knocked out a lot of U.S. fracking in places like Texas and North Dakota. What's at stake here for the U.S. energy industry with these talks that OPEC is going through?
In the short term, not much, because we've had ample opportunity the entire summer, the producer that is, to lock in future production 2 years out at well over $70 a barrel. So the industry recognized the opportunity they had over the last few months and took advantage of it. So we are well hedged at this point. Also, in 2014, you're correct. It absolutely hurt the economy. It really hurt the oil economy. But OPEC, at the end of the day, really did the industry a favor. They did all of the Fed's heavy lifting. Remember, the industry really got fat because of the artificial cost of capital. So the pullback in oil prices in 14 and 15 really forced the industry to retrench. Margins are much higher. So these companies, the frackers, so forth, can make money at lower prices. So we're not nearly as vulnerable as we were 4 years ago.
Yesterday, we heard from the CEO of Marathon Petroleum. I interviewed Chairman and CEO Gary Heminger about the recent sell-off in crude. Listen to what he said. Got to get your reaction.
Sure.
I know that this could be an indicator of slowdown in global growth. That sometimes is indicative in the price of oil, or maybe it's telling us something only about the oversupply situation. To what do you attribute this sharp sell-off?
I really look at the oversupply situation. If you look at the Permian, it continues to grow rapidly. The Bakken has come back strong, as well as the foreign markets. The Middle East production and the Middle East production coming into the U.S. has put pressure on the supply here in the U.S.
Your thoughts?
Yes, I don't disagree with that, Maria, and we see this in the forward curve in pricing. 6 months ago, the spot price, the price for oil today, as opposed to the price of oil next month, 2 months, 3 months hence, the spot price 6 months ago was at a premium. So when your spot price in any commodity is at a premium, that's telling you that demand is overwhelming supply. But over the 6 months, we've had that inversion now, where the spot price is cheaper than price out into the future. So this is clearly, at the best, a market that is well supplied. At the worst, as far as the industry is concerned, it's a sign that the market is oversupplied. So OPEC should, the Saudis should cut, but should, would, could are the most useless verbs out there. So we have the situation, the Saudis aren't going to do anything without the Russians. And also, keep in mind, we have the Iranians, and the Iranians have a point. They're under sanctions now. They're not going to jump on board with any sort of sanctions. So we're really at loggerheads at this point.
Stephen, real quick, what's the level that really cuts into the shale producers' profitability? Is it below 50?
It's going to be below 50 is a psychological number. There are a lot more plays that can make, depending on the location, make money at $50, but we're really at that kind of DY over DX moment, that inflection point. If we go much lower, and the models suggest we can go to the mid-40s, then you're going to start to see some pain in the industry.
Yeah, and then we could start seeing layoffs in the oil sector. We saw that the last time this happened. Stephen, good to see you this morning. Thanks very much. Stephen Schork joining us there. Coming up, Paris is closed. French officials shutting down popular tourist destinations as they look to curb the slew of violent protests. Wait till you see what's going on there. And then jobs in America. We are bringing you full coverage of the November jobs report beginning at 8 a.m. Eastern this morning. Stay with us. Mornings with Maria is live this morning from Washington, D.C. all morning. Back in a moment.